Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to look at the economy overall. We want to really kind of dig in and say, okay, well, what did the overall economy do, in the backdrop of COVID? What has stimulus done? Do we still need more? What does it look like in terms of the U.S.? And then we're going to look at unemployment and what does that really mean for us going forward as we continue to see lockdowns and other, let's just say economic issues. So before we really dive in, there's one thing that my wife and I and others have been really talking about, and the question is, what do we do about school and what do we do about normal winter activities? When we think about the average adult gets between 2 to 3 colds every winter, and then obviously kids get something exponentially above that, what do? Do you get a cold and immediately go to the doctor for testing? We know that children show COVID signs much different than adults. So do you have to quarantine your child and get them tested? And do you have to test your children before you go see relatives? Because they're at school, they could be exposed and you don't know, they could be asymptomatic. These are these interesting concepts that we're trying to think about of, how much normalcy can we really see on a demand level from oil, gasoline, and other in terms of just shopping, consumerism in the fall and winter months as we start to look and think about these things as we go forward. So now that we've talked about these fun, different components that we'll also touch on in the first segment, let's kind of jump into the U.S. real Q2 GDP. So it came in at 32.9, slightly better than estimates, which were a little bit above down 34%. But the difference really comes at the as we looked at June. So June, things got a little bit better. We had some normalization. May into June looked a lot better in terms of where we were going. But now we're starting to see those issues that arose from June into July. So now the assumption is that we're going to get a big, essentially recouping some of this in Q3, but we continue to see headwinds with those recuperation. PMI has gotten a little bit better. We've seen some benefits from that, but we also continue to see unemployment creeping higher and higher and continuing claims remaining sticky. So those are key aspects that we're really going to kind of look at in segment 2 and 3 to really look at, okay, what is unemployment doing? What is happening going forward that could really impact the benefits of Q3 and into the end of the year. And the reason why we continue to question that is when we look at a country like Germany. So Germany's expectations was for a decline of 9%. Instead, they came in at about negative 10.1%. And the reason why this is one to focus on, just like we talk about Japan, South Korea, and unfortunately China, if we try to sift through the noise, they have an economy that's very much driven by exports. So as we think about exports, they're a good bellwether for how well is the global macro economy? How is shipping and exports and demand really looking on a global level? And here's something where you can see it was weak through Q2. Now, some of the PMIs, some of the data has gotten a little bit better, but we also have to consider they were coming off of a much lower base. And some of the data that we're starting to see is saying that they're starting to show some weakness as we go into July, into August. But again, July so far was a positive month, and we saw June close out relatively strong. So the question is going to be, what do we look at going forward? And that's why we talk about the Oxford Stringency Index. Now, as you get closer to 100, you're at an all stop. So you can kind of see, obviously, between March and May, we had those peak shutdowns. Now, the question is going to be, what do we look like going forward? When we think about tourism being anywhere from 9% to 15% of GDP, depending on the country, Italy, for an example, is about 9% tourism goes straight to the GDP line. So we know that we're going to lose tourism. We know that there's going to be a slowdown through the end of the year at least. So they can't risk shutting down again. So the question is, how do you protect industries? How do you keep people active while still trying to enforce some social distancing to not roll backwards? Germany has experienced their first real spike since they started to reopen. And France has made a lot of progress. And those are things that they don't want to face in terms of having to have new lockdowns, new rollbacks, because they have made that progress and they have to try to make up for that loss in tourism, which is going to only come from production and just local consumption from the people within the country. So these are things that we're going to consider as we start going into COVID. So when we first look at the U.S., we can see that things have started to normalize a bit, as we have some peaks that have been reached in Arizona, Texas, Florida, and California. And the question is, the 7-day rolling average is starting to move over a little bit, which is, again, a positive. We've seen hospitalizations, especially in Arizona, decline, and we've seen things starting to peak in Texas. Given where, Texas as a whole, because there's still some specific hotspots within the country, but deaths are starting to creep higher. And you have to think about, okay, well, what's the timing delay when we think about the different times from sickness, from illness, from hospitalization to death? And the one benefit for where we are is in terms of treatments. We've learned a significant amount since February when we had those huge string of deaths. And it's really, keeping people off of ventilators, pushing them on CPAP, using steroids, using forced means of dehydration to take fluid away. And also, more importantly, the anticoagulants or the blood thinners to keep some of the clots that were forming in lungs and then spreading, causing organ failure and really kind of leading to death. So those are key aspects where we're learning more. But when we think of things on a global level, we still continue to see daily new cases rising, and we do see daily deaths continuing to rise when we look at a 7-day moving average. And these are problems as we go into the winter months. And we have to consider, it's like, okay, well, China, Germany, Japan, Australia are all seeing new outbreaks, and specifically Japan and Australia have seen some of the biggest. And Japan is talking about possibly putting in new measures of emergency, cutting working hours, limiting the amount of people that can be at restaurants in terms of at specific tables. And Australia saw their largest 1-day climb. So these are things that we have to consider as we start going into our winter months. And this is another surge in terms of just deaths. Again, we've learned, but we still see deaths creeping higher, specifically in Latin America. And Latin America is important for the U.S. when we consider about where our exports go, where things in terms of just our general trade. And this is going to be a problem. We've seen the same thing in India. And as it'll be interesting to see how this reacts as we go through the remainder of the year, specifically through the fall and winter seasons. And when we consider the fall and winter seasons, this was an interesting chart just looking at childcare, virtual classrooms, and homeschooling. And you can see this is just searching. Childcare searches have gone down because people are like, what, I'm going to be working from home anyway. We'll figure it out. We'll keep them at home. So I don't need to search for childcare. But virtual classrooms and homeschooling have exploded. I don't know if you've had conversations with friends or family or in terms of pods or keeping kids out of school, having a pod with people that or social distancing or quarantining in a certain way, and you can control the atmosphere or environment a little bit better, as well as virtual classrooms. These are key aspects that I really do think will weigh on consumer consumption and really the general ability to reach normalcy as we go through some of these winter months, which again leads to the daily activity indicators. And these are these high frequency indicators that we're always looking at. And again, you can see things are starting to kind of roll over. We talked about Japan. Japan is starting to roll back over, and we'll update this once the new data comes out. But again, we've been struggling to break that 85% normalcy as we start to see things kind of roll back over and kind of hang between that 60, 80 level and really kind of average 75%, which is something that we think is going to be a ceiling that's going to be hard to break as we go forward. And then when we look at this from a setup between emerging markets, advanced economies, China, advanced economies are doing a little bit better and emerging markets are kind of flattening out. And we have to go back to that death scale. Where are the deaths? They're in more emerging markets. So that's weighing on people getting back to normal, seeing, an economic revitalization that we think is going to be difficult to see, at least until we have some meaningful vaccine cure, whatever you want to call it, to get people more comfortable. China is the one that we believe is rolling over a bit harder as they face flooding, their own outbreaks in specific provinces. And just as we showed before, just general export and global macro demand. And that's where we start to look to, the people who like to spend the most, and it's the U.S. citizen. And here you can see consumer confidence. Some of these expectations of present situations are starting to fall. And as these things start to fall, you have to consider, it's like, well, it's because people are concerned about unemployment. People are concerned about, their job security. But at the same time, it's, am I going to have enough money to really feed my family, which we'll talk about in a little bit. And when you consider expectations, this is where we can go into global mobility. And this is where we like to talk about the mobility breakdown between some key countries. And here you can start to see things rolling over a bit. One of the big ones for us has been Japan, which we've now seen start to really fall as they've had a rise in new cases. And the US, again, has kind of flattened out, which is not something we think is going to change over the next month or two. And India is the one that's really started to kind of creep lower. And as the deaths continue to rise within the country, we think this is something that's going to accelerate as, whether you want to call it a second wave or a continuation of the first, these are going to be key problems that are going to be weighing on just general activity. And just to drill in on the US a little bit more, we can look at the New York Fed Weekly Economic Index, and you can see it's really started to roll back over and kind of hang at that down 40% level. And if you want to consider retail sales, thinking about discount stores, people who may not be shopping at Target, but going to the discount to try to save money, you can see that sales are starting to roll back over as, again, maybe kids aren't going back to school and you used to shop there for back to school supplies. These are things that we have to look at to see are consumer trends really changing and or at least not recovering or following the same trend that we initially saw through the back half of Q2. Now that we've looked at the global economy, let's turn to stimulus. It's one thing where the GOP have come out and said that they wanted $200 stimulus instead of the $600 when we're thinking about additional benefits on unemployment, and it failed to pass. The Democrats continue to want $600. The GOP continues to want something that's below $600. Is $200 really going to work? And this is where we start to look at the actual disbursements on just, fiscal payments. We had the stimulus check of about $1,200 that really hit throughout April and started to kind of bleed into May. We had the PPP loans, which really kind of carried us through, again, the end of May and bled into June. But now we're really being carried specifically from the additional unemployment benefits. So now that those are expected to drop off, as they expire in July, and we start to face the first week without those additional without the additional check. And these are things that we have to consider when you're thinking about, okay, well, do I have to save more because it's never coming back? Do I have to change my spending habits? And this is where we start to get concerned as we go from July into August, because these are a lot of unknowns, which will cause consumers to pull back until they have a bit more clarity on what they can expect on their week-to-week, month-to-month daily income. And these are key things that are going to continue to be impactful, because you can see the stimulus and the amount it actually drove in terms of billions to the everyday American. And these are key aspects that the GOP and the Democrats are looking at to say, okay, well, what makes the most sense? Because our fiscal balance sheet is just absurd, and how much can we really continue to borrow and or print as Powell and the Fed continue to take the US dollar to the woodshed. And so when we look at, just looking at the backdrop, let's think about, okay, who benefits the most? And these are some interesting data points as we look at the change in wealth, starting from 1989. And you can see the different breakdowns on the different age gaps. And you have to consider, well, why does this matter? Who benefits the most from stock prices going higher or some unemployment checks? Or, who's going to benefit from, the monetary policies that we've seen if you don't own an asset? If you don't own a home, if you don't, own a hard asset, are you really benefiting? If you don't have a stock portfolio, are you really benefiting from a lot of these benefits? Because if your unemployment check is cut, and you don't own an asset, well, inflation is just going to continue to hurt you because there's no way to offset that. And that's why we look at the ownership of US equities. And you can see that 32 trillion is really with 55 and older. And that's an inherent problem. And we can talk about Robinhood and all this other nonsense of where $1,200 really goes. But these are, hard portfolios that are 401ks, pension funds, things that provide a certain amount of protection in this stimulus world, as we're 200 handles or so from all-time highs, even though based on the GDP numbers that we just showed and the PMIs and other economic indicators that continue to weigh. And when we consider, okay, well, what does this mean going forward? And we look at the wealth by generation. So the real estate wealth for baby boomers is about 15 trillion, and for millennials it's about 1.1 trillion. So we have to consider about where home prices currently are and where they were and who is really seeing that appreciation. And these are some of the hurdles that we've seen as millennials look to go from urban to suburban. Do they have the ability of the down payment? Some of these key aspects as we see baby boomers that have a huge chunk of the real estate. And this helps kind of show, okay, well, if they own equities, where do they own them? And there's a mixture between corporate, mutual funds, and pensions that really make up the huge chunk of just retirement funds and other. And that's why when we talk about and see things that are happening in the market, the monetary stimulus is really not getting to the people that may need it the most. And that's where we turn to, okay, well, what is happening on the fiscal side? And the fiscal side continues to essentially, let's just say, misallocate funds or put them into places that really aren't, trickling down to the people who need it most. And that's why we look at, on a broad level, where is the fiscal balance percent of GDP? And you can see just across the G7, the US is one of the worst at 16.9% in terms of GDP. And this is going to be a huge problem, because at what point do we limit the ability to borrow? Do people say, if you want to continue to borrow, I'm going to need a higher interest rate, or I'm just not going to borrow I'm not going to lend you the amount you require to close this gap. And we can see how painful it is across the board. The other problem is it doesn't correct itself in 2021, 2022, 2023. This is a problem that we've seen coming into this year and exiting this year. We already have a record amount of global debt in the market, and the current situation is not making that any better. And that's why when we look at fiscal balance, on 2020, if we look at this chart to the right, you can see that on a global level, it's negative 11%. I mean, these are huge issues when we consider, well, what can the emerging markets do? Because inherently in your head, you're thinking, okay, well, if the US dollar goes down, then that means that emerging markets will benefit. But if emerging markets can't sell their products, capitalize on some of these benefits, can they really see this kind of utopia of cheap dollars, invest, borrow? It's just going to be a problem as we go forward. And when we look at all of these key components, we have to think about, well, what's happening on the lending side? We're starting to see expectations that credit standards are going to start to tighten. And as that starts to tighten, it's because the government is starting to take a step back, specifically with PPP loans, some other forms of stimulus, which is going to adjust what the credit standards are going to be. So we talk about the shift in terms of real estate and this move from urban to suburban. But if you didn't get a mortgage yet, are you going to be able to get one? Are the credit standards going to continue to tighten? And if you think about the fear of losing a job, or maybe you have lost your job, some of the requirements are showing pay stubs, current pay stubs, letterhead of the company that you work for, to prove that you have a job and it's something that's going to be sustainable, because there's just so much unknown as we look at an unemployment level. Now we can turn to unemployment and some of the issues that are facing the industry. And here we can jump right into Yelp. So something that we've started to notice is you're starting to see businesses go from temporarily closed to permanent. And this is something that is continuing to rise as we go forward, and a chart will show next. But again, it's not really surprising to think about who in terms of restaurants, shopping, and retail. But again, these are permanent job losses. These are job losses that aren't coming back based on, say you can say, all right, well, we cleared the glut and we get new new businesses opening up, but based on tightening of loans and credit, are we really going to see an immediate turnaround, especially as people are unsure of what their situation is going to be going forward? And this is why some of these problems are going to continue to weigh as we go through the remainder of the year. And here you can see just, permanent closures have continued to increase, and the temporary has dropped, as we've seen with some lockdowns being rolled back. But you're starting to see some pauses, and these pauses are going to kind of keep some of these temporary closures, moving to the right. But at the same time, we're starting to see this increase of permanent. Is the answer another round of PPP loans? Is it another round of some form of SBA loans to help protect and stymie some of the closures? And the question is, the answer is I don't really know. There's a lot. I can go both sides. I can say why we shouldn't, why we should, but these are real data points that is going to continue to weigh on just the global, the U.S. economy as we continue to see small businesses start to shutter or at least remain closed, which is going to limit tax revenue and just consumer spending. Because as Powell said during his remarks yesterday, when they decided to keep rates flat, essentially in perpetuity, if you want to look at the charts, he came out and said that company investments just aren't there. We've seen consumer spending kind of come back and close about half the gap, but we're still not seeing an investment on the corporation level, which is going to be a huge weight on the economy if we really expect to see a huge resurgence or at least a recovery in Q3. And that's when we turn to, recruiters. What is the recruitment levels? What are people really saying or really trying to do? And you're seeing that human resources and recruitments are down considerably. And it's just indicative that when a position is closed, whether the person is let go or they leave on their own, it's just not being filled. That actual position is just permanently gone. And this is a bigger issue as we go forward when we start to think about, okay, well, where are the jobs? How are people going to get new employment? And it's going to be very difficult from a recruitment level, but also a human resources level. So what are the recruiters doing? And then what is the actual corporation doing? And we can see the big drop. And there's always seasonality in this. Like there's better times to find a job versus others. But you can see that this is something that's going to kind of continue to hang around the bottom. September into, let's call it early November, are some of the best times. So it'll be interesting to see how this really adjusts, or if it does adjust, because when we look at applications for employments, we can kind of see that we're kind of hanging to the right here. And we'd want to see the applications, but also the job interviews start to increase as we go through into September and into October, because August should be another slower month. But again, this is just an interesting data point that we're going to continue to look at to see, do we have a recovery? Are people starting to feel better? And this comes back to business investment. Are people investing in people? Are they starting to reopen jobs that may have been paused and or closed? Because now that they feel a little bit better, that their business is starting to improve and they can start to hire a bit more. And this comes back to the unemployment figures. When we look at initial claims, initial claims were topped estimates at about 1.4 million. And you can see it just kind of continues to hang, where we've had a continuous increase of initial jobless claims of over 1 million over the last 17 weeks or so. And the other problem is continuing claims. Continuing claims, topped estimates, and we still sit at about 17 million. And you can see that small increase. And if we turn back to permanent closures, some of the lockdowns remaining in place or getting put back in place, or some of the reopening slowed, that's where you're starting to see some of these new unemployment numbers starting to tick higher, which is why we continue to look at long-term or at least continuing claims, because it continues to weigh on the market. And that's when we turn to Indeed, just another data point that we're looking at to show the disconnect between 2018 and 2019, again, factoring in that key seasonality, because typically, seasonally you start to see a slowdown, but you can see how far off we are from previous years at the same time of year. And this is going to be something that we're, again, going to continue to look at. But just given where we are in the market, we think that there's going to be a steady increase of not only continuing claims, but also initial claims remaining in that elevated plus 1 million people per week. And this this starts to get to the question of food insufficiency. We've talked about it aggressively when we start to think about, what is happening in the U.S. If it's happening in the U.S. at this increasing level, what does it look like at an emerging market level? If we start to consider, the cents per dollar that go towards food, we've estimated it's gone from about 65 cents to about 80 cents in the emerging markets, and anywhere from 15 cents to about 25, 30 cents in the U.S. And this is going to be a bigger issue as the Congress goes back and forth on what should unemployment be, should we increase, should we decrease, and these are going to be the real issues that people are facing as we go forward. It also comes down, well, what about housing strains? What are people doing on the housing side in terms of partial payments, no payments? And this kind of shows you the delinquencies that we've seen April through July. Now, given July isn't finished, and as we start looking into August, the numbers should start to get a little bit better based on some indications that we've seen from other data points. But again, it's not going to go from 30% to 15%. It's going to kind of remain at this, let's call it 25 to 30% through at least August and into September. And as these unemployment benefits start to go away, people start to get concerned about, well, do I have a job? Can I get a job? Can I feed my family? Well, what am I going to do on the housing component? And then when we shift it to just the remainder of the U.S., what does the U.S. look like? And this is an interesting data point, looking at, who is at risk of eviction and what does that mean? And someone brought up a good point. Well, it's like, well, what is this normally? And when you're doing some of that research, normally it can be anywhere from 5 to 15%, depending on the state, the status of the local economy. So you can see that it has increased anywhere from, let's call it, 10 to 50%, depending on where you are. And these are real issues that have to be addressed. And again, these are the things that are going to continue to weigh on people spending money, the consumer as a whole. And really, if you can't spend, then the industry can't sell, and you start to get this kind of reverberation through the system where we kind of have this stagnation or deflation depending on where we are. The problem is the inflation numbers. Everyone talks about inflation, and it's real. The Fed will tell you it's one thing. Some people may believe it is the numbers that they quote. But if you've ever paid for healthcare, education, been to the grocery store, inflation is real. And inflation is well higher than what they're saying it is. And that's something that when you look at gold, you look at silver, it's a natural inflation protection. And these are things that we're going to continue to evaluate and look at. So, as we go into the end of the week, on Friday, we're going to touch on, obviously, our favorite topic, the primary vision Frac Spread Count, and provide a little recap in terms of what did some of the new GDP numbers do, and really what is happening in the OPEC markets. We have our OPEC show that just came out, but we've also had some new pricing points that we'll touch on, and to see how is that going to impact U.S. completions as we go through the remainder of the summer. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.